Remember September 15th, 2008? The day Lehman Brothers collapsed with over $600 billion in assets. It was the worst financial disaster since the Great Depression. The market crashed 54%. $11 trillion in household wealth just vanished. 8 million Americans lost their jobs. 10 million lost their homes. The world was teetering on the edge of complete financial annihilation. And I'm here to tell you that 2008 is going to look like a mild correction compared to what is coming next. Why? Because every single metric that predicted the 2008 crisis is now flashing red, at levels 2 to 10 times worse than they were right before Lehman fell. The debt is bigger, the leverage is higher, the bubble is larger, and the tools we used to fight it last time, they've already been used up. This isn't fear-mongering, this is just math, and the math is terrifying. By the end of this video, you will understand exactly why the coming crash will make 2008 look small when the warning signs say it will arrive, and what you need to do before the window of opportunity closes. Welcome to Dark Finance File. Let me show you something that should keep you awake at night. In 2008, the total US national debt was $9.4 trillion. Today, it's $38.5 trillion. That's a 310% increase. In 2008, the Federal Reserve's balance sheet was $900 billion. Today, it's $7.4 trillion, a 722% increase. How about derivatives? In 2008, total derivatives exposure was $170 trillion. Today, it's over $632 trillion, almost 4 times larger. In 2008, the US stock market was valued at 80% of GDP. Today, it's at 195% of GDP, nearly 2.5 times higher. Do you see the pattern? Every single warning indicator that preceded the 2008 crisis is now screaming at multiples of those levels. And here's what should truly frighten you. In 2008, the Federal Reserve had room to cut interest rates, all the way from 5.25% down to 0. They had a clean balance sheet they could expand. They had credibility they could spend. But today, rates are already suppressed. The balance sheet is already bloated. All the ammunition has already been fired. When this crash comes, there is no rescue plan. There is no cavalry riding to the rescue. There is only the cold, hard mathematics of a bubble that has grown too large to sustain. The 2008 crisis was just a warning shot. What's coming is the main event. Thanks for watching, and be sure to subscribe for more insights. Before I show you the pattern that proves a crash is coming, let me just overwhelm you with the data, because numbers don't lie, even when Wall Street does. Let's start with valuations. The Shiller P/E ratio, which compares stock prices to 10 years of earnings, is at 37.4. Before the 2008 crash, it was 27.4. We are 36% higher than that pre-crisis peak. The Buffett indicator, total market value against GDP, reads 195%. In 2008, it was 80%. We are 144% higher than before the last crash. By every traditional measure, stocks have never been more expensive. Now, look at debt. Total US debt across all sectors is over $101 trillion, and in 2008, it was $52 trillion. We've nearly doubled it. Corporate debt alone has exploded from $6.5 trillion to over $13.7 trillion, and a quarter of that is rated just one step above junk. Household debt just hit a record $17.9 trillion, with credit card delinquencies rising at the fastest rate since 2008. Then there's leverage. Margin debt is over $780 billion, more than double what it was in 2008. And the banking system is sitting on $700 billion in unrealized losses. Every single metric that caused the 2008 crash is now at a record extreme, and nobody is talking about it. So, let me show you the pattern, the exact framework that explains why crashes happen and why the next one could be catastrophic. I call it the 5 pillars of systemic collapse. Every major financial crisis in modern history has followed this exact sequence. Pillar 1. Asset bubble formation. Prices get disconnected from value, and speculation takes over. Pillar 2. Excessive leverage and debt. The bubble is funded by borrowed money, creating a house of cards. Pillar 3. Hidden systemic risk. The risk concentrates in complex ways that regulators don't see until it's too late. Pillar 4. A catalyst event. Something small triggers the unwind. A bank failure, a policy error, anything. Pillar 5. Cascade failure. Leverage works in reverse. Forced selling causes more forced selling, and the whole system implodes. In 2008, all 5 pillars aligned. Housing was the bubble, subprime was the hidden risk, and Lehman Brothers was the catalyst. Right now, all 5 pillars are aligned again, but at a scale that dwarfs 2008. Let me prove it with history. Take the Great Depression. The Roaring Twenties saw a huge stock bubble, fueled by massive leverage. Investors bought stocks with just 10% down. The other 90% was borrowed. Then, Black Thursday hit. The catalyst, margin calls, triggered a cascade of forced selling. The Dow fell 89%. Thousands of banks failed. Unemployment hit 25%. The pillars were all there. The pattern was verified. The question is, can you see the pattern repeating today? Stay tuned as we dive deeper. Let's look at another case, the dot-com crash of 2000. In the late 90s, internet companies with no earnings or even a real business model were suddenly worth billions. Remember Pets, Com or Webvan. The Nasdaq soared 400% in 5 years. Experts said it was a new era where clicks mattered more than profits. Valuations went through the roof, totally disconnected from reality. Then, the bubble popped. Between March 2000 and October 2002, the Nasdaq plummeted 78%. Over $7 trillion in market value just vanished. But here's the key difference. The system could handle it. National debt was a fraction of what it is today. Banks weren't filled with toxic assets. The Fed had room to act, cutting interest rates from 6.5% all the way down to 1% to stimulate the economy. The system had flexibility. That flexibility is gone now. Now for the big one, the 2008 financial crisis. This is the blueprint for what's coming. By 2006, the housing market was a massive bubble. Banks were giving mortgages to almost anyone. Wall Street packaged these risky loans into complex securities and sold them as safe AAA-rated investments. The entire financial system was contaminated. When housing prices fell, mortgage defaults surged, and these securities became worthless. Lehman Brothers failed, credit markets froze, and the whole system was on the verge of collapse. The government stepped in with everything they had: bailouts, liquidity, zero interest rates. It barely worked. But here's the crucial part. The solutions for 2008 created the problems of today. They didn't fix the debt. They just moved it to the government. They blew up new asset bubbles. They postponed the crisis and made it bigger. 3 crashes, 3 clear patterns. Now, let's see why 2025 could be worse than all of them combined, using those same patterns, the 5 pillars of collapse. Pillar 1. Asset bubble formation. Today's stock market is in one of the biggest bubbles ever. But it's not just stocks. It's real estate, bonds, crypto. It's an everything bubble. And everything bubbles pop catastrophically. Pillar 2. Excessive debt. Total U.S. debt is over $100 trillion. Government, corporate, and household debt are all at historic highs. The system is leveraged to the absolute limit. Pillar 3. Hidden systemic risk. The derivatives market is a multi-hundred trillion dollar web of risk, mostly held by just a few big banks. The shadow banking system is massive and unregulated. Commercial real estate is a ticking time bomb for regional banks. The risks are hidden in plain sight, just like in 2008. Pillar 4. The catalyst. It could be anything. A bank failure, a geopolitical shock, a major policy mistake. The system is so fragile, any significant shock could set off the chain reaction. Pillar 5. Cascade failure. When the catalyst hits, the dominoes will fall. But this time, the tools that saved us in 2008 are already maxed out. Interest rates can't be cut much further. The government is already running massive deficits. There's no room for another huge bailout. When this cascade begins, there may be no rescue. The pattern is complete, and by every measure it looks far more severe than 2008. Thanks for watching. What if I told you the next global financial crisis isn't just a possibility, it's a mathematical certainty, and it's closer than you think? Forget what the mainstream media is telling you. Let's talk about the 5 pillars of collapse and what you can really expect. In the next 6 to 18 months, you're going to see the cracks appear. Market volatility won't be a fluke. It'll be the new normal. Corporate earnings will start to disappoint, big time. We'll see credit stress emerge in places we were told were safe. That feeling of complacency, that belief that stocks only go up, it's going to shatter. Then, within the next 1 to 3 years, the catalyst will hit. It could be anything: a major bank failure, a sudden geopolitical crisis, a catastrophic policy mistake, or simply the moment when there are no buyers left at these insane prices. And when that domino falls, the cascade will be faster and more brutal than 2008. Why? Because the system is more fragile than ever. The leverage is higher, the global financial system is more interconnected, and the central banks have fewer tools left to save the day. A 50% to 70% drop in the stock market isn't fear-mongering. It's just math. It's what happens when bubble valuations revert to their historical average. When this happens, it will trigger the largest wealth transfer in modern history. Those who are prepared will have the chance to buy assets at prices we haven't seen in a generation. Those who are not prepared will see their wealth evaporate, becoming the source of liquidity for the smart money. The only question is, which side will you be on? If this breakdown makes sense, if you feel like you're not getting the full story elsewhere, then subscribe to Dark Finance File right now and hit that notification bell. You need to see my next video. I'm going to reveal the 5 specific warning signs that will signal the crash has officially begun, weeks or even months before the rest of the world has any idea what's happening. These are the canary in the coal mine indicators that have preceded every major crash in history. And guess what? They're starting to flash red right now. You absolutely cannot afford to miss this information. The pattern is undeniable. The bubble is real. The crash is coming. And our time to prepare is running out. This is Dark Finance File. Stay informed, stay prepared, stay ahead. Ever wonder what a real financial crash looks like before it happens? Here's what to expect based on the 5 pillars of collapse. In the next 6 to 18 months, the cracks will become visible. Volatility will spike, earnings will disappoint, and credit stress will emerge. Then, within 1 to 3 years, a catalyst will arrive, a bank failure, a geopolitical crisis, something that triggers the cascade. And when it starts, it'll be faster and more severe than 2008. The system is more leveraged, more interconnected, and the rescue tools are weaker. A 50 to 70% market decline isn't fear-mongering. It's a return to historical norms from today's extreme valuations. If this analysis showed you something the mainstream media won't touch, subscribe to Dark Finance File now. In my next video, I'll reveal the 5 specific warning signs that signal the crash has begun, weeks before most people realize it. You can't afford to miss this. Stay prepared, stay ahead.